So COVID-19 is still going on, but as and when it happened, I just call it the post-COVID era. And I think this COVID situation is a big game changer, right? It's like the Noah Ark, right? It's like a great reset. I would say after this, right, you will see there are certain companies, especially the tech companies, they will do very, very well, all right? And there's this saying, right, like, bad companies will go bankrupt, good companies will survive, but great companies will thrive, right? Great companies will thrive. So during this job, right, as the market keeps pulling out, right, I do not want to just find okay company, like good company only. Right? I want to find great companies that will thrive. So as a case in point, I would say those like traditional companies like they have good branding on, like Disney, McDonald's, Nike. These are good companies, and they have enough cash flow, like solid branding, good economic mode, and they have enough cash flow to tank through this whole situation for sure, right? One of the top players, one of the top leaders in their industry. But will they actually thrive in the post-COVID era? Right. So this is a question that you need to think about it. You will realize that because these companies are so great, like so good, right? Most of the time the market will price them at a premium. For me, I don't mind because like just now I use the Visa example. Like every time I buy at a high price above 20% above valuations, if Visa that year can grow 20%, I recover back already, but I'm in the game already. But if I'm waiting for it to drop, over the last 10 years, have Visa ever been at a fair valuation? If you use traditional way to evaluate the company, you might not get a chance to get in. Right, so you have been like looking Visa from $20 go all the way to $200, and then you're still waiting for the fair valuation. So this is something to consider about, right? So I would say if you're looking at great companies, for me personally, right, valuation will be secondary. Okay, and which sectors will thrive? All right, so obviously the e-commerce companies, all right, online platform, like anything that is more online, right, where the company is platform-based companies. Firstly, they are more COVID resilient. So you realize this COVID situation, can the next flu come along like 2 years later? Hey, you never know, right? So those companies that can manage to just barely survive this situation, like I would say, let's say Disney. Right now, nobody's watching movies, and I'm not sure when when people will go to like theaters to watch movies again, right? But you guess they probably got enough cash to survive this. But hey, how many times can you survive this kind of situation? Right, like you survive a heart attack, but if the next one come along 2 years later, how can your body take it? Right, so resilient is a very important keyword here, lah. And software companies, all right, Microsoft, Adobe, Datadog, all right, these are the companies that I think will do well, right? And what else, right? What other companies do you think, or industries, right, are able to leapfrog their competitors and come out from this relatively stronger compared to their competitors or their other companies in mind? Okay. So again, when I look at your company, look at your basket of companies. So this is a very polarized statement. Okay, don't be angry at me if you feel offended, or if you have these companies in your portfolio. But I will say, right, if your portfolio, you have companies like the traditional heavyweights like Nike, McDonald's, Starbucks, Disney, even like Boeing, these kind of companies. I think these are good companies, definitely not wrong. But I would say the opportunity cost of you having these companies in your portfolio is quite substantial. Opportunity cost, right? That means, like I would say, if you put your money in, I think you will not. I think in the next few years you'll be doing fine, right? But the opportunity cost of not making like 20-30%, year after year for the next few years is very high. Okay, so this is why you want to pack the best of the best companies into the portfolio, not just a good enough company, but the best of the best. So some of you are settling for good company, right? Please do not settle for good company. Only find the best of the best that's available out there. So let me share a few different templates for different investors. So again, right, based on what I covered in a few slides earlier, the two considerations that you need to juggle, right, is your risk versus reward. So it's just like driving a car. You want to get from point A to point B. It's about how fast you can get there, your speed, all right, which is your ROI, and how risky it is, all right. How risky it is also dependent on how well you are as a driver. If you are more experienced, you are a seasoned investor, you have been investing for the last 20 years, then obviously, you are able to more volatility, more ups and downs in the market. So risk and reward. All right, how many of you think that if I can make 15 to 20% a year, very safe, not the highest return, but it's pretty safe, and then it's a passive approach, I don't have to spend too much time monitoring it, read out about what the CEO said and all that, right? Is pretty good, right? 15 to 20% per year. So if you don't mind this, right, what you can do is you can go for this ETF, right? QQQ is the symbol for the Nasdaq, which is the top 100 companies in the US. So this is a NASDAQ again, all right? And over the last, let's say 10 years or so, right? Can see, right? Last 10 years or so, it went up from like, I don't know, 450 to about 243. So if I were to compare it with, say, the SPY, S&P 500, obviously outperformed. So there are some good ETFs out there, okay? Personally, I like 𝐿𝐴, 𝐈𝐴. 𝐈𝐴 is a digital payment ETF, and it only started, I think, 2015. And 𝐿𝐴. 𝐿𝐴 is the tech ETF, all right? And doing not too bad. And you realize, right, these ETFs, they will outperform the general S&P 500, the top 500 companies in the US, right? And if you just go with S&P, it's doing pretty well, right? But personally, if I can go with the top 100, why do I want to go with the top 500, right? Because like top 100 probably will outperform the top 500. When you're looking at these companies, it's about which one is more suitable for you. Okay, like if you're buying a car, it's not about which one can drive the fastest. It's about which one you personally like, lah. For those of you who are interested, you can go to ETFDB, all right, and check out the companies that's in the portfolio. Let's say, do you even know what is inside 𝐿𝐴? You can go to holdings, and there's a breakdown, all right. And one thing with 𝐿𝐴, right, is Microsoft and Apple. It's very top heavy and very top skewed towards Microsoft and Apple. These two companies take up 40% of the whole portfolio, right? And then Visa, Mastercard, and then etc. 𝐿𝐴, I would say, is more balanced. So you can read already when you have time what is the ETF about. But let me just show you the holdings. All right, so again, Apple and Microsoft is the top holdings, but can you see it's like not so high. It's like maybe 10, 11%, right? And then Amazon 10%, Google is 6% because Class A and Class C share together. So if you like these top 5 companies, Apple, Microsoft, Amazon, Facebook, Google, why not just go with 𝐿𝐴? It's easier for you also. If I'm structuring this portfolio for a very, very safe person who do not want to see too much volatility, if it's a sizable retirement fund, all right, every year they just need to live on 15 or 20%, then I will just go 𝐿𝐴. It saves the trouble, it saves the volatility. So when you are structuring a portfolio, right, don't just look at the potential rewards, right? Look at the risk or the volatility that you need to have in mind also, all right? So the next one, right, will be, I would say more is conservative, but the rewards will be a bit higher, okay? So it's what I call growth compounders, right? So these companies, right, are like very, very safe companies. Everyone knows them. But at the same time, right, all of these companies, I think it's fair to say, they are still growing at a very, very good, like year on year or quarter after quarter. They are growing at a 20, 30% returns. If I have 5K, this is how I will position my portfolio. And I have like 20% in cash because right now, with the context that right now the market is really, really pushing quite high, and I'm looking at a slight pullback. So I will just hold just 20% in cash, but the bulk of it will be invested, right, in these 4 companies. And actually, my top company is actually Amazon. But you realize, right, Amazon right now is like 2006, right, with 5K, right? And if I were to have 1 share of Amazon, that means I have more than 50% of my portfolio in a single company, which breaks the diversification rule. As my portfolio gets bigger, and if I can get into 1 share of Amazon and not more than 30% of my portfolio, I will make the switch. Right? I will try to squeeze Amazon in. And the other one will be more aggressive. Right? I would say the risk is not very aggressive, but maybe like medium risk. Right? And risk here, right, is more about volatility. It's just like when I take a roller coaster, my heart will go up and down. But the chances of me dying at a roller coaster, right, is like almost negligible. But am I comfortable, ups and downs? Some of us are okay, some of us are not okay. Let's say if I'm a working adult, right? And most of you guys are. If 5K or 4K could be just 1 or 2 months of your salary, and you can easily just make it back. It's not that hard to replace. I am willing to take a bit more volatility in this portfolio with the potential of hitting 2 or 3 times my portfolio. So my 5K within 1 or 2 years can go up to like not just 10K, but like 15K, 20K. Okay. So innovators and disruptor companies, right? You realize as tech evolve, there will be a lot of companies like they are disruptive. All the good companies, like all the tech companies right now, like Google, Facebook, Amazon, all of them became the size it was today because they were disrupting the previous status, right? Like for example, Apple come out, it's not about how much market share they have. They create a new market by themselves with the iPhones, right? Companies like that, right? Like Tesla, it's not exactly a company they're just selling cars, right? It's like electric cars. They are way ahead of the game. And to me, if you really understand like what Elon Musk is trying to do, it's not really an electric vehicle company per se, right? So they are all about like changing the world and making a more green environment, right? And Square is a digital payment company in the US, and it's a bit similar like GrabPay, right? So nowadays with GrabPay, not just you can just buy food or pay for, right? But you can buy insurance, you can you can do a lot of things, right? So with Square, they are trying to build a whole ecosystem that might even replace the banks, right? So because right now, like companies like Visa, MasterCard, they still need to tie in with the banks. So what Square is trying to do is they are trying to create a whole ecosystem for themselves. And I personally see that future lah. So this is why I invested in it, right? So these are some of the companies that are innovating, are disrupting the industry. If you believe in it, then you can invest. So there are so many companies out there that are very, very good, right? I only get 5K. If I just a 5K portfolio, I cannot choose that many companies anyway. I'll just go with a few that I think have the best potential, right? Yeah, 5K templates, okay? Okay, yes, 9:30 already. Okay, see you guys. All right, hope you guys learned this session. Okay, have a good evening, everyone. See you guys.